There's a sound most phones make now. A soft chime. A small green check mark. It takes less than 2 seconds, start to finish, and in those 2 seconds your phone cannot tell the difference between for completely different things: paying for a coffee, financing a couch you can't afford yet, placing a bet you'll regret by halftime, or watching last month's mistake quietly become this month's minimum payment. Same sound. Same checkmark. Same 2 seconds. Your grandparents would not recognize this as spending money at all. To them, spending had weight, coins that grew heavier in a pocket, a wallet that visibly thinned across a week, a hand physically letting go of something. So here's the question this entire video is going to answer: if the feeling of spending money used to be so specific, what happened to make it all collapse into one identical, weightless chime? Something did happen. It happened slowly, then all at once, across roughly 2 decades, and almost nobody noticed the exact moment it finished, because by the time it finished, there was no friction left to notice it by. Rewind to the turn of the millennium, and cash was still how most Americans under 40 paid for a coffee. By the time smartphones normalized tapping a screen instead of handing over a bill, an entire generation had grown into adulthood having barely touched the physical thing money used to be. The shift wasn't announced. It was just quietly, steadily, never reversed. Start in a lab at MIT in 2001, because this is where researchers first caught the collapse beginning, years before anyone had a smartphone in their pocket. 2 professors ran a silent auction for tickets to a sold-out Boston Celtics game, the kind of tickets nobody could just walk up and buy anymore. Half the bidders were told they'd pay in cash if they won. Half were told they'd pay by credit card. Same tickets. Same seats. Same desire, presumably, to see the game. The credit card bidders didn't just bid a little higher. They bid, on average, somewhere between 64 and over 100% higher, for the exact same tickets, than the cash bidders did. Nearly double, for identical seats, based on nothing except which piece of paper or plastic they expected to hand over weeks later, once the excitement of game night had already faded. Picture that in a single room, 2 people, staring at the identical seats, one of them silently deciding those seats are worth nearly double what the other one thinks they're worth, and the only difference between them is which piece of paper or plastic they were told they'd hand over later. Here's the part that should stop you: nothing about the tickets changed. Only the method of paying for them did. Which means the price a person is willing to pay isn't really about the item at all. It's about how much the payment itself hurts on the way out. That hurt has a name. Researchers call it the pain of paying, and for 20 years the leading theory was simple: credit cards numb it. Handing over plastic doesn't feel like losing anything, so the brain's natural brake, the one that makes you hesitate over a price tag, never fully engages. But a follow-up study, 20 years later, using actual brain scanners, found something stranger, and it's the twist that changes everything else in this video. Credit cards weren't just failing to trigger pain. They were actively triggering reward. Watching people make real purchases inside an fMRI machine, researchers found credit card transactions lit up the striatum, the same dopamine-driven reward region implicated in cocaine and amphetamine use. The lead researcher put the finding in 5 words: credit cards don't release the brakes. They step on the gas. Sit with that for a second, because it reframes the entire premise of this video. This was never just about numbness. Somewhere in the last 2 decades, the moment of paying stopped being neutral and started being pleasurable, on its own, independent of whatever you actually bought that day. Which raises the obvious next question: if a piece of plastic can do that, what happens when you remove the plastic entirely? Enter the phone. Tap to Pay strips out the last remaining friction a credit card still had: the search through a wallet, the swipe, the wait. Now it's a tap, sometimes not even that, just proximity, held near a reader for less time than it takes to read this sentence. The MIT researcher behind the striatum study said the quiet part out loud in his own write-up. As we move toward a cashless society, the simple act of holding a phone near a reader could be enough, on its own, to trigger an appetite for spending. Not the purchase. Just the gesture. Now watch what gets built directly on top of that gesture, because this is where the story turns from uncomfortable to genuinely alarming. Picture someone at a checkout screen, late at night, not in a store, online, cart full, total higher than expected. A button appears, friendly, almost apologetic, for payments, 0 interest, pay the first quarter today. That's buy now, pay later, and it removed the one thing even a credit card still had left, a single, total number you had to look at all at once before deciding. Break that number into for smaller ones, and each individual payment feels almost too small to argue with. $22 today doesn't trigger the same hesitation $88 would, even though it's the exact same $88, just wearing a disguise. Here's the twist economists didn't see coming. Regulators call what's building up behind those small payments phantom debt, because unlike a credit card, most of these loans never showed up on a credit report at all, invisible to the exact system designed to catch someone borrowing more than they can handle. In 2026, 47% of buy now, pay later users reported paying late at least once that year. 2 years earlier, it was 34%, a 13-point jump in 2 years while the industry kept insisting its own default numbers looked fine. Nearly 2/3 of users are now juggling more than one of these loans at the same time, a quarter of them 3 or more, spread across different apps that have no idea the others exist, each one seeing only its own small, harmless-looking slice of a much bigger picture. And here's the detail that should genuinely unsettle you: a growing share of these loans aren't financing furniture or electronics anymore. People are now splitting grocery bills into 4 payments, financing dinner 2 weeks after they already ate it, the checkmark chiming at the register exactly the same way it would for a couch. Ask yourself honestly, when did borrowing money to buy groceries stop sounding like an emergency and start sounding like a checkout option? If buy now, pay later fragmented the number, one more app removed the purchase entirely and replaced it with something closer to a slot machine you carry in your pocket. In 2018, the Supreme Court struck down the federal ban on sports betting. Within a few years, something like 1/5 of American adults, and nearly half of men under 50, had opened an account on an app built by companies who understand the striatum every bit as well as the MIT researchers do. Picture someone on a Sunday afternoon, phone propped against a coffee mug, game already on in the background, a parlay bet sitting 3 legs deep. Live, in-game betting means a new wager is available every few minutes, not just before kickoff, an entire second game of decisions layered on top of the one actually being played on the screen. And the app's most powerful trick isn't a win at all. It's the near miss, a parlay that loses on the very last game, by 1 point, in the final second, close enough to feel like it almost happened. Brain imaging research going back to 2009 found that a near miss lights up the exact same reward circuitry as an actual win. Your brain, in that specific moment, genuinely cannot fully tell the difference between winning and almost winning. The house can tell the difference perfectly. That's precisely why the app is built to manufacture near misses as often as it possibly can, parlays specifically, because a 3-leg parlay that loses on the 3rd leg feels nothing like a clean loss. It feels like the app owes you a rematch. Since legalization, searches for gambling addiction help have climbed nationally by roughly a quarter, and in some states where betting apps arrived hardest and fastest, that jump has approached 50%. Not because more people suddenly became reckless. Because the device engineering the near miss is now sitting in the same pocket as the device that pays for lunch, indistinguishable from it, one tap away, at every single moment of every single day, chiming with the identical friendly sound whether you just won $200 or lost your rent. Here's where all four of these threads, the card, the tap, the four payments, the bet, finally tie into one single object. Dopamine was never firing because of what you were buying. It was firing because of the gesture itself, the tap, the swipe, the checkmark, repeated so many times across so many different apps that your brain built one identical response to all of it. A grocery bill. A couch. A parlay bet. A late fee compounding on last month's late fee. Your nervous system stopped being able to tell them apart, because the industries building these apps made absolutely sure it never had to. They didn't coordinate with each other, exactly. They didn't need to. They were all independently chasing the same striatum, using the same tools, and they all arrived, separately, at the same 2-second chime. None of this means the coffee shop is secretly a casino, and none of it means every credit card swipe is a moral failure. It means the specific, physical, felt difference between spending money and not spending money, the thing that used to make a purchase feel like a decision instead of a reflex, has been engineered out of the transaction on purpose, by people who get paid every single time you don't notice it's gone. Think about the last thing you bought without quite meaning to. Not the big purchase you agonized over. The small one. The one that arrived 2 days later and made you wonder, a little, when exactly you decided to buy it. Maybe you don't remember typing a card number, because you didn't have to. Maybe you don't remember comparing it to anything else, because the button that completed the purchase was the same button you tap 40 times a day for things that cost nothing at all. That gap, between the decision you don't remember making and the box on your doorstep, is not a personal failing. It's the product working exactly as intended, by people who tested dozens of versions of that exact button until they found the one that made the fewest people stop and think. So here's what actually helps, and it isn't use more willpower, because willpower was never competing on a fair field against a reward circuit designed by people with fMRI data and a full-time budget for exactly this problem. Rebuild the friction on purpose. A 24-hour pause before any purchase over a set amount does what a wallet used to do automatically. It puts a gap between the gesture and the consequence, a gap the entire industry has spent 2 decades trying to close. If the urge survives the wait, it was probably a real decision. If it doesn't, the chime already did its job, and the wait just saved you the money. Turn off saved payment methods for anything beyond routine bills, so every purchase requires typing the number in again by hand, one small manual reintroduction of the exact friction that got engineered away on purpose. It costs you 15 extra seconds. It costs the app the entire advantage it was built around. Treat any buy now, pay later offer as what it actually is underneath the friendly button, a loan, in 4 pieces, disguised as a convenience. Ask the same question you'd ask before signing any other loan. Can I afford the whole number today, not just the quarter of it sitting in front of me right now? If the honest answer is no, the 4-payment version was never actually a better deal. It was the same debt, wearing a nicer outfit. And if a betting app is on your phone, know exactly what a near miss is doing to your brain in that half second before you tap again, because the app already knows, in far more detail than you do, exactly how close to almost winning keeps you playing the longest. Once a month, actually look at every recurring charge and every app with your card saved on file, out loud, on a real screen, not a mental guess. Most people can name 3 or 4. Most people actually have 12 to 20, quietly chiming their way through a bank account one small, forgettable transaction at a time. Go back to that sound. The chime. The green check mark. It's going to play the next time you pay for something, and the time after that, and it is never going to sound any different depending on what it just cost you. That was never a flaw in the design. It was the entire design. There was a version of this, not that long ago, where money had a texture. Where running out of it felt like something in your hand, not just a number turning red on a screen you'd already stopped really looking at. That version didn't disappear in one visible moment anyone could point to and grieve. It was removed one convenience at a time, one friendly button at a time, each individual step small enough to wave through without a second thought, until the version of you reading this sentence can't quite remember the last time a purchase made your pulse do anything at all. Somewhere on your phone right now, that same soft chime is waiting to play again. It has absolutely no idea, and no interest in knowing, whether what you're about to buy is something you need, something you'll regret by morning, or something you already can't remember choosing at all. It was never built to know the difference. It was built so that you'd stop asking,